We got a read of economic growth in Canada that suggests that the economy is still quite sluggish, chugging along at around 1% for the third quarter, which is below the Bank of Canada's own forecast of 1.5%. Let's bring in Royce Mendes, who is Managing Director and Head of Macro Strategy at Desjardins. I don't know, is this number telling us something we didn't already know?
Not really. I mean, you look back to the summer and we all knew the economy was pretty sluggish. What I was interested in was the September flash data. That's the most recent number. That includes some numbers from a time when rate cuts were starting to flow through the economy. And you saw a big rebound. I think there's some reason for optimism in that part of the number. We know that the summer was weak. Yes, it's below the Bank of Canada's forecast, but central bankers are forward-looking. So they're going to try to weight the most recent numbers more than ones that are further back in history. And when you look at that, you say, oh, well, the fourth quarter could actually look pretty decent in terms of economic activity.
So does that derail this idea that the bank could do another outsized rate cut?
I don't think it completely derails it. Obviously, there are major risk events between now and December. There are major risk events in the next few days alone. And so it definitely doesn't derail the likelihood or the possibility of a 50 basis point rate cut. But I wouldn't say the ingredients are all there to make a strong case for a 50 basis point rate cut just yet. I mean, if you look at what was driving that September GDP growth, it was things like retail trade, which is very interest rate sensitive. Earlier in the year, we were worried that the retail sector was so weak despite population growth exploding. So people individually were actually pulling back. Now we're talking about the retail sector expanding. Is it just coincidence that it happened around the time that rate cuts were being delivered and even picked up? I'm not sure. I think there could be some correlation or causation there.
The bank has so much time to absorb all these events. The next decision is not till December 11th, and a lot is going to happen between then, to your point. The Fed's going to move. There'll be an election. Hopefully in the U.S. we'll know by then who the president is and what the policies are. And I hear you that maybe the thesis is a little dented on another 50 basis point rate cut. But what about the argument that if you look at the economic data, where employment is, where GDP growth is, where the output gap is, rates are still restrictive and quite restrictive relative to what rates were when the data points were similar a couple years ago?
Yeah, I would say a few things to that. First of all is that I had no problem with the last 50 basis point rate cut. I think we were one of the first shops to change our call to say that the bank needed to accelerate the pace of rate cutting. But this is like administering any medicine. You have to get the dosage right. And if you administer too little, you won't get the effect you want. But if you administer too much, it's dangerous. And so we're trying to balance that as we move ahead. You look at things like the Canadian dollar, it's sold off quite materially. That's, will feed into inflation temporarily, but it'll also feed into financial conditions. It should make the outlook for exports better than it was previously. It makes us more competitive on the global stage. We know that we need any edge possible in competitiveness because our productivity is so woefully weak. So I think that when you look at everything together, there's an argument for 25 or 50 right now, but it's tough to justify that just because we're above a theoretical neutral rate that we should immediately drop the hammer and lower rates to that level.
You mentioned the dollar. Obviously, it's sold off because, oil's down, but also importantly, the rate differential between Canadian interest rates and U.S. rates are getting wide. And Tiff Macklem has said it's fine. And it can be fine for a little while longer. Are you as confident that it's fine and it can be fine?
I think it is fine, but it plays into the calculus of calibrating that next rate cut. I mean, I think generally speaking, central banks shouldn't try to target the exchange rate. They should stick to what they've been tasked with by the government, which is targeting inflation. And so the exchange rate will move based on different fundamentals in different jurisdictions, and they'll come together and meet up at the exchange rate. So I don't have a problem with getting to 70 cents on the Canadian dollar, even a little bit below that. But what I would have an issue with is if you built on top of that financial conditions easing a whole lot of extra rate cuts, and then you ended up restoking, let's say, the housing market or something more than it needs to be. We know
that's just not happening because people are, the job market is a little worse, and people are expecting rate cuts to come down. So that deflationary spiral is actually happening in the rates market.
Yeah, you have some expectation that rates are going to come down. And I think that's relatively fair that rates, if you look further out, aside from the December argument for 25 or 50, if you look to January or March or April of next year, I would say the rates market and basically everyone agrees that the rates need to be lower than they are today. It's how fast you get there and where the balance of risks lies around that. You want to keep the balance of risks relatively in the middle. You don't want to risk, going too fast and then you end up doing something that you didn't intend to.
Let's weave in politics. Under a possible Trump presidency, there is a concern about tariffs, and there's a question to what extent Canada will be ensnared or be an exception to some of the tariffs. Is there a reaction function by the central banks? Can they do anything to offset whatever tariffs do? Like, is that an arrow in the quiver to deal with it?
Yeah, first they'll be focused on uncertainty. That would argue for more rate cuts. But then if policies are implemented to raise tariffs and thicken the border between Canada and the U.S., we're not going to benefit from as much from U.S. growth. So that would augur or that would argue more for additional rate cuts. But, there's politics on that side of the border. There's also politics on this side of the border. We are getting some new mortgage rules introduced in mid-December. That should help stoke our housing market. We're getting checks sent out in Ontario in January. And, we are headed likely for a federal election sooner rather than later. And I can't imagine that the federal government isn't going to do something to help stimulate this weak economy. And that's all going to come into play in the minds of these monetary policymakers.
Do we have the fiscal space for that?
At the federal level, I would say yes. And actually, what we saw from Ontario yesterday, you can see that they are on a path to balance. Now, more medium term, we definitely have challenges. But when I think about our challenges versus the challenges of our peers in the G7, we are the cleanest shirt in the dirty laundry basket.
Royce,